Procter and Gamble, PG stock. Founded in 1837 and loved for the dividend increase of 66 years in a row. Procter and Gamble is not all about the growth, but this is a steady dividend stock, and which lets you have an easy rest at night. Procter and Gamble owns so much brands and products you will find one in every home. But is this steady dividend paying stock also a buy right now? In this video I will show you everything you need to know about Procter and Gamble. I will show you what they do and I will show you my fundamental analysis to see if PG stock is a buy or not. I'm also going to check the dividends and of course the competitors. I'm very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. Please subscribe to join the community and also to receive multiple analyses every week, where I will tell you everything you need to know about the stock market. So, what does Procter & Gamble do? Procter & Gamble is an American consumer goods giant specializing in a wide range of personal care and hygiene products. They are the 13th largest company in the US by market cap. It operates with a lineup of leading brands including 21 brands that generate more than 1 billion each in annual global sales. Sales outside its home turf represent around 55% of the firm's consolidated total, with around 1/3 coming from the emerging markets. So the great thing about Procter & Gamble is they generate revenue from brands and products that everybody uses and also will use in the future. They have been around for a long time and it's highly likely this company will be here in the future. More than 180 countries sell the products of Procter & Gamble. 5 billion people use their products. And one of the core strategy of PG is innovation. PG has invested more than 2 billion in research and development. They have almost 7,000 R&D employees, more than 900 employees with a PhD, and 37,000 patents. So they may be old, but they are innovating the company, brands and products more than anyone else in this industry. When we check the revenue breakdown by business segment, we see that the fabric and homeware are representing 34% of the total revenue, more than 1/3 of the total. Baby, feminine and family care are representing 25%, beauty 19%, healthcare 13%, and grooming is the smallest with 9%. When we check the geolocation, we see that North America is responsible for almost half of the total revenue. Europe is at 22% and Greater China is at 10%. This means there are still a lot of opportunities in some parts of the world. Now that we know a bit more about the company Procter & Gamble, it's time to check the historical stock price and compare them to some competitors. I'll check Procter & Gamble and compare them to the S&P 500, the Vanguard Consumer Staples ETF and Colgate-Palmolive, one of the main competitors. When we check the 5-year chart, we see that PG stock is up almost 76%, while the S&P 500 is up 88%. The Vanguard Consumer Staples ETF is up 44% and Colgate-Palmolive is up only 9.8%. So the S&P 500 is definitely the winner here, but Procter & Gamble is at the second spot. On the 1-year chart, we see that PG stock is definitely the winner with almost a 70% return. Second spot, the Vanguard Consumer Staples ETF with a 13% return. On the 1-month chart, we see that everybody is around 9% except for the S&P 500. And this is also the point I'm trying to make. People like buying stocks like PG and Colgate-Palmolive during volatile times, because this business will continue to operate at the same pace as usual. So this is a great thing to keep in mind. Next up are the fundamentals of this company. Procter & Gamble is a 383 billion market cap company, and as mentioned earlier, they are the 13th largest US company by market cap. The current PE ratio is at 28 and the forward PE ratio is at 25. To be honest, 25 and 28 is a premium I want to pay for companies with a high compound annual growth rate in revenue. Companies that are considered growth stocks or dividend growth stocks, such as Starbucks, Microsoft, Apple and all other companies, but not Procter & Gamble. So to be honest, this PE ratio is a little bit too high for me. I would love to see it a little bit lower. But you also have to keep in mind that companies are trading for a higher PE ratio nowadays. But this is something you have to figure out yourself. Do you think a PE ratio of 28 is too high for Procter and Gamble? Please let me know your thoughts in the comments. When we check margins, we see that operating margin is at 23% and profit margin is at 18.5%. For a consumer staples company, this is quite high. I would love to see it above 10%. PG is way above that, so that comforts me a lot. Return on assets is at 9.5%, which is below my minimum of 10%. But to be honest, it's almost there, so it's not that big of a problem, I think. Return on equity is sitting at 31%, which is great. The 12 trailing month revenue is sitting at $78 billion, and the quarterly revenue growth year over year is sitting at 6%, which is quite nice for a company like this. They won't grow double digit, but that's okay. This company is all about the slow and steady pace. When we check the revenue of PG, we see that in 2014 it fell down from 80 billion to roughly 65 billion. Since then, it climbed all the way up again to 78 billion. The thing I like the most is the consistency of the last 5 years. It's growing at a steady pace, which comforts me a lot. The EPS went up and down a lot in the past years, but since 2020 the EPS is growing big time and also at all-time highs. When we check the balance sheet, we see that PG has a total cash of 11.5 billion, but a total debt of 35 billion. The operating cash flow is sitting at almost 18 billion. This means they are capable of paying down half of the total debt, which is a great thing. But I must say, I do think they should pay down debt in higher amounts or increase the free cash flow. Right now, operating cash flow is sitting at 18 billion and leverage free cash flow is sitting at 11.7 billion. Companies use free cash flow to pay down debt, buy back shares, do acquisitions, research and development, and of course pay dividends. So it's really important for a company like PG that free cash flow is increasing. Right now I think they are on track to increase the free cash flow a lot. In the past 10 years it's always been between 10 and 60 billion, but to be honest I would love to see it a bit more steadier and increasing at a steady pace. Since 2018 it's increasing and I'm really excited to see what happens in the coming years. As mentioned a minute ago, companies use free cash flow to buy back shares, and this is something I like about PG. They buy back a decent amount of shares. In the last 5 years they bought back 6%, which isn't the highest number to be honest, but it's acceptable for me. When companies are buying back shares, the EPS will go up, which attracts other investors and your share will become more valuable. Next to that, the total dividends paid will be decreasing, which means it's more easier to maintain and increase the dividends in the future. Both things are really important to Procter & Gamble, so they are doing a great job here. When we check the dividends, we see that PG pays a 2.3% dividend yield at an annual payout of $3.65 a share. Payout ratio is at 60%, which is quite high. I would prefer to see it between 20 and 45%. This will allow the company to spend more than enough on R&D and also on share buybacks. Right now they only have 40% left on free cash flow to invest in R&D, share buyback, acquisitions and paying down debt. The 5-year growth rate of the dividends is sitting at 5.3%, which isn't the highest, but again, you are not investing in a dividend growth stock, but more in a defensive dividend stock. And you have to keep in mind that PG increased the dividends for 65 years in a row, which is really impressive. The last thing I want to discuss are the fundamentals of PG versus some competitors. In this case, Colgate-Palmolive, ticker symbol CL, Church & Dwight, ticker symbol CHD, and the Clorox company, ticker symbol CLX. The first thing that catches the eye is that PG is by far the biggest company in terms of market cap, enterprise value and employees. The PE ratio was a little bit too high in my opinion right now for PG, but we see that CHD and CLX both have a higher PE ratio. Colgate-Palmolive has the lowest PE ratio of almost 25. The price to free cash flow is really similar with every company and it's sitting around 20 to 21. The revenue growth year over year is also similar with every company sitting at 6% except for CLX, where it's at minus 6%. When checking the revenue compound annual growth rate, we see that CHD is definitely the winner here. But PG is the winner at the EPS year over year growth and the compound annual growth rate, which is quite nice. PG is also the winner at the leverage free cash flow compound annual growth rate, where CLX is at the minus 20%. There's a big difference in gross profit margin and also in net income margin. PG is definitely the winner for the net income margin, sitting at 18.5%, where CLX is only at 3.5%. Return on equity is quite similar again at every company except for CL. Same story with the return on assets. CL is again the winner here. When checking the balance sheet, we see that PG has by far the most cash, but also has the highest debt in amount of dollars. But when checking the debt to free cash flow ratio, we see that all companies are around 6.5 except for CLX, which is sitting at 15. The last thing I want to check are the dividends. PG pays a 2.3% dividend yield, similar to CL. The lowest dividend yield is at CHD and the highest at CLX. When we check the dividend growth, I think it's safe to say that PG is definitely the biggest winner here. My final conclusion is that companies like PG are always nice to have, but you shouldn't pay a premium for them. I do have shares of PG, but I bought them back a long time ago, and I'm really happy with it. This is a solid company and it's still growing as we saw. It isn't a growth stock, but that's okay. Sometimes it's nice to have a somewhat of a boring company in your portfolio for a bit more peace during volatile weeks or months. This stock won't let you down. But on the other hand, it isn't the biggest grower in your portfolio as well. I think when the PE ratio will go down just a little bit, PG is definitely a buy. For now, I'm just waiting and keep collecting the dividends. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.